Right, so we want to take a look at IFRS 15 revenue from contracts with customers. Right, so we'll start by looking at recognition of revenue. How do we recognize revenue and when do we recognize revenue? So revenue is recognized as the supplier fulfills the performance obligations at the point that control is transferred or over time in accordance with completion. That's what IFRS 15 says concerning recognition of revenue. So we want to unpick this statement and see what it means. Do a few examples, and then after that, you'll be good to go in terms of how we recognize revenue. All right, so the standard sets 5 steps that needs to be followed before we can recognize revenue, or these are the conditions that we need to look for before we can then say we are recognizing revenue. Right, so the first step is to identify whether or not there is actually a contract of sale. So we need to identify the contract that is resulted in the sale. Do we have one party that is selling a product or a service? Do we have another party that is taking control of the product or receiving the service in exchange for a consideration, which means one party should be providing the service, the other party should be giving the payment, or one party should be giving the service or the product, and the other party should be making a payment, whether it's cash, it's in exchange for something. There should be a consideration if there is a contract of sale. The second step is for us to identify the obligations. So we are saying, what are the obligations of the seller as per the contract, or what does the seller have to do to fulfill the contract? So for example, if it is a contract of sale, I'm selling a laptop to you, my obligation is to deliver the laptop to you, that then fulfills the contract. We need to determine the price or the consideration that is going to be paid in exchange for satisfaction of the obligation as identified above. So if you have identified that the obligation is, I'm selling a laptop to you, so I'm obliged to deliver the laptop, how much are you going to give me for delivering that laptop? That's basically the price. Allocation means there are certain circumstances where in a contract of sale, the seller may have more than one obligation. So for example, I'm selling you a laptop and then I'm committing to provide the service of that particular laptop over a period of say 1 year. So it means I have an obligation, 1, to deliver the laptop that I've sold to you. I have an obligation, 2, to service the laptop over a period of 1 year, right? So we have determined that there are 2 obligations, and then we are then determining the price that you are paying for both the service and the laptop. We need to then allocate the price between the obligations. So what part of the amount that you have paid is going to the purchase of the laptop? What part of the payment you have made is going to go towards the service of the laptop? That's allocating the price to the obligations as identified. Then we need to apply the add or over. So we're going to talk about what it means when we're saying add or over. So revenue is recognized as the supplier fulfills the performance obligations that we have identified there using the 5 steps. So there are 2 models that we follow, the add model or the over model. The add model usually applies to the sale of goods, and the over model usually applies to the sale of services. Right, so add model, we are saying revenue is recognized at the point that control is transferred. So we are saying if I'm selling a laptop to you, once I give the laptop to you, it means all the risks associated with the laptop, so all the rewards that comes with the laptop are transferring to you. The control over the laptop is transferred to you. It's now in your hands. You are the one who is controlling it. You have taken physical possession of the goods that I have sold to you. So it means as soon as I transfer control of the laptop, you now have the risks and rewards, the physical possession, and you're controlling the laptop. It means I can recognize revenue at that point in time. Then over means revenue is recognized over time in accordance with completion. So if I've then promised to offer service of the laptop over a period of 1 year, it means whatever amount you are giving me should then be spread over the 1 year. So I am recognizing revenue over a period over which I am providing the service. So the over model usually applies where there is no other use for the commodity or the goods that I've given to you. So for example, I've entered into a contract with you to construct a jurao at your house. So perhaps I'm constructing this jurao over a period of 3 months. Maybe you are paying the money upfront. I can't recognize all of the revenue now because I'm building the jurao over a period of 3 months. It means at the end of the first month, I recognize part of the revenue. At the end of the second month, I recognize part of it. At the end of the third month, I recognize part of it. So we usually apply the offer model 1 where there is no other use for the goods that I have given to you. So I can't take the jurao away from your home and sell it to someone else. So there's no other use for the jurao that I'm constructing for you. Is the simultaneous consumption and performance, which means you are benefiting from my satisfaction of my obligation. So perhaps as I am building, you are actually benefiting from what I have built. Or another example could be, we are offering perhaps teaching services. So each time I deliver a lecture, you are actually benefiting, but you are supposed to benefit for a period of 3 months, which is a full semester. So it means if I'm recognizing the revenue that you give me, I'm recognizing it over the period of the semester because you're actually benefiting simultaneously as I perform or as I teach you. So that's basically the offer model. Now, when we are looking at the 8 model, is simple and straightforward. If I'm selling goods to you, the moment you take ownership or control of the goods, I can recognize revenue because you're the one who is now controlling the goods. But for contracts that are performed over time, it means I'm charging you today, but I may need time to deliver on my obligations. So a classic example for the offer model is a construction project. So maybe I'm constructing a building for you. The building construction is taking a period of, say, 1 year. Now I want to determine which portion of the revenue I can recognize now. Or let's use an example, say 3 years. Maybe the construction project is taking a period of 3 years. At the end of the first year, I need to determine how much of the revenue or of the amount I've charged you can I recognize as revenue this year. And now there are 2 different methods that we can use. We have the output methods and the input method. So in terms of output method, we are determining how much of the total amount I charged you I should recognize on the revenue based on what I have already produced, which is the output. So if it is maybe a contract to produce and sell to you a certain number of units of a product, if the promise is to supply 100 units and I have supplied 60 units, it means I've supplied 60% of the units, which means I am entitled to recognize revenue of 60% of the total contract price. So I'm using the units I've already produced. Contract milestones are like, for example, if I'm constructing a building, we can agree that when we get to the foundation level, I'm entitled to a certain amount of money. When I get to the window level, then I get to the roof level. So those are milestones. So it means when I reach the first milestone, I can then recognize the component of the revenue attached to that particular milestone. Surveys of work performed means perhaps I'm constructing a building and then we hire an expert to tell us what percentage of completion he thinks we have reached. That percentage is the one that we use to then recognize it. If you are saying, if the expert says you are 30% through, and perhaps we have charged 100,000 for the full project, we are basically saying 30% of the 100,000 is what we can recognize as revenue based on what the surveyor or the expert would have said. That's basically the output method. Then the input method is not about what we have already produced, but what we have put into the project. So one classic example is using costs incurred. So we costed the job and said perhaps we are going to incur 100,000 to finish this job. So if we have incurred 50,000 to date, it may then mean we are halfway through the project, considering that we're estimating that we're going to be spending 100,000 in total to finish the project. Machine hours, basically, we are saying if we are able to estimate the total machine hours that we are going to work on a particular project, and say, for example, we are going to work 10,000 hours on this project. If up to the end of this year, we've worked 5,000 of the 10,000 hours, it means we are halfway through the project. Time elapsed means we would have estimated, let's say, for example, this project is going to take 2 years to complete. So if it has been 6 months since we have started the project, it means we're basically going to say 6 months over the 24 months. We multiply by the total amount that we would have charged for this project. We are basing on the time that is elapsed to determine how much we can recognize as revenue. So we are going to look at examples on how the output method works and how the input method works. But before we do that, let's practice in terms of the 5 steps. So on 1 December 2023, we had received an order from a customer for a computer as well as 12 months of technical support. Word delivers the computer and transferred its legal title to the customer on the same day. The customer paid $420 upfront. The computer sells for $300 and the technical support sells for $120. Word's year end is 31 December 2023. Okay, so we are saying we entered into a contract of sale on 1 December. So remember the 5 steps. So we wanted to consider whether these transactions meets the recognition criteria for revenue. So step 1, we need to recognize whether there is actually a contract of sale or not. So we received an order from a customer for a computer and technical support. We delivered that computer on the same day, which means we have entered into a contract of sale for a computer and technical services, which means we've satisfied step number 1. Is there a contract of sale? So yes, there's a contract of sale of a computer and technical service. Right. Then we want to go to step number 2. So what are our obligations as the seller? What are we obliged to do? So number 1, we are obliged to transfer ownership of a computer. We are also obliged, number 2, to offer technical services. So these are the 2 obligations that we have. We go to step number 3. So how much is the cost of this contract? Okay, so the customer is paying us $420. So we are going to receive $420. So step number 4, we need to then allocate this $420, that is the contract price, to the obligations that would have identified under step number 2. So we are told that the computer sells for $300, which means for the computer, which is the first obligation, we are going to recognize revenue of 300. Then number 2, for the technical service, we are told that the technical support sells for 120. The total of these 2 is the 420 that we have received. Now, step number 5, we now wanted to apply the add or the offer model, or the add and the offer model. So we are told that we had delivered the computer and it transferred its legal title to the customer on the same day, which means on the first obligation where we are selling the computer, we have actually delivered that computer, which means the control, the risk, and the rewards are now with the customer. So the customer is taken physical possession, which means we can immediately recognize revenue of 300. Then we are told that the 120 technical support is going to be over a period of 12 months. Now, this transaction happened on 1 December. Our year end is 31 December, which means we cannot recognize the whole 120, considering that the whole 120 is for a 12-month period. Now, since it has been a month since this transaction happened, and this is 31 December, it means we're then basically saying 120 divided by 12, right, to determine how much we need to then recognize as revenue in the current month. So if you say 120 divided by 12, we get 10, which means the total revenue that we need to recognize is the 300, which relates to the computer that we've transferred on 1 December, plus the 10, that is the portion of the 120 associated with the technical support we've already provided in the first month. The remaining 110 is for the 11th month. We've not yet satisfied that obligation because we have not yet provided that technical support, which means the total amount of money that we're going to recognize as revenue as at 31 December 2023 becomes 310. So that's basically how we apply the 5 steps of recognizing revenue. Okay, so let's move on to further specific applications. So there are a number of applications of this standard in relation to revenue. We are not going to look at all of them. We are going to look at the other specific applications in the later modules. But for now, this is what we want to cover. So we want to see how we then account for revenue recorded over time. The example that we have used is in its simplest form. In reality, recognition of revenue over time is a bit more complicated than that. So that's what we want to look at. So for each performance obligation satisfied over time, an entity shall recognize revenue over time by measuring the progress towards complete satisfaction of the performance obligation. So if we have promised to do certain things of a certain period of time, what we want to determine is, of the things that we promised, what have we done so far? And then determine, so what is the percentage of what we have done in relation to what we need to do until we complete the project. That's then the percentage we use to determine how much of the total contract price we need to recognize as revenue in the current year. So we've already talked about this. There are 2 different methods of measuring this. The output method, what have we done so far in terms of output? Then the input method, what have we put into the project in terms of the costs we have incurred to date? Okay, so there's a 4-step approach that we need to follow. So you need to be careful if you're asked a question in an exam. These are the steps that you need to follow. So if the question is asking you about the amounts that we are including in the statement of profit and loss, you need to know you are calculating up to the 3rd step. If the question wants you to highlight what we are going to recognize in the statement of financial position, you are going all the way to the 4th step. So the first step is we need to determine whether or not the project or the contract is going to result in a profit or a loss. So the first thing is, let's calculate the overall profit or loss. How much have we charged the customer in terms of the contract price? How much have we incurred in terms of costs? And how much are we expecting to incur in the future until we have satisfied all of the contractual obligations? So if the contract price is 100,000, and for now, we have incurred 20,000. And we are anticipating that we are going to incur a further 40,000. It means the cost we are going to incur is 20 we have already incurred, plus 40,000 we are expecting to incur, which means we're expecting to incur a total of 60,000. We have charged 100,000, which means the profit we are expecting is 40,000. So that's the first step. Are we expecting to make a profit or not? The second step is we are going to then determine the progress towards completion. If we are anticipating that we are going to be getting total revenue of 100,000 from this contract or from this project, we want to determine how much of the 100,000 we need to recognize as revenue at the end of the current year. So it depends on whether we're using the input method or the output method. If we're using the output method, what have we done so far in relation to what we need to do until we finish the contract? Are we 30% through? Are we 80% through? If we are 80% through, then we can recognize 80% of the total revenue that we are going to be getting from the contract. That's step number 2. Then step number 3 is to determine the figures for inclusion in the statement of profit and loss. So for inclusion in the statement of profit and loss, we need to determine the revenue that we need to recognize based on the progress we have made. We need to determine the cost of sales we need to recognize based on the progress we've made, and then be able to calculate the gross profit for that particular project. So how much revenue should we recognize? How much is the cost of sales to date? And what is the profit? So that's as far as the profit and loss is concerned. Then we need to determine figures for inclusion in the statement of financial reports. We are going to talk about this a bit more because there are certain instances where the work we have done entitles us to say $10,000. But up to now, the amount of money that we have received from the customer amounting to say 8,000, which means up to now, the customers owe us 2,000. The 10,000 we have earned, less the 8,000 they have paid, which means we've got a contract asset of 2,000, money that they should have paid us, but have not yet paid us. The instance could be we are entitled to 10,000, but we have received 12,000 already from the customer, which means we are the ones who owe them 2,000 because they've paid us for work that we have not yet done. So that's the determination of the figures that we need to include in the statement of financial position. Right, so let's look at the 4 steps in a bit of more detail. So the first step we have said, we calculate overall profit. So what is the contract price? What is the total amount of money that we've charged the customer? We subtract the cost that we have already incurred to date. How much money have we spent on this project that we need to recover from the revenue that we charge the customer? What are the estimated costs to complete? The costs that we are estimating that we need to still incur before we can say we've delivered a finished product to the customer. So if we remove what we've incurred and what we plan to incur from the total revenue or contract price, what we then get is the overall profit or loss. So if the expected outcome is a profit, means revenue and cost should then be recognized in accordance with the progress of the contract. Progress of the contract is step number 2. So if we have determined that from this project we are going to make a profit, it means we need to recognize a portion of revenue, recognize a portion of cost of sales, and create and calculate our gross profit from that project. That's what we include in the statement of profit and loss. But if the expected outcome is a loss, we have calculated the contract price and we've determined that what we have incurred and what we need to still incur will be more than the contract price, such that the contract will actually result in a loss. The whole loss should then be recognized immediately by creating a provision for an onerous contract. So an onerous contract is a contract where the cost of going ahead with the contract is more than the income that is going to come from the contract. So we're estimating that we're actually going to be spending more than what we're going to receive. That's an onerous contract. So what we then need to determine is, so what is the cost of continuing, or what is the amount of loss we are going to make? So for example, if we continue with this project, we are going to make an overall loss of 10,000. So what we then need to consider is, so should we continue with the project? So in determining whether we should continue with the project, we then look at the cost of canceling the project. So if we're going to cancel the contract today and say, we are not going ahead with it anymore, how much would we be charged to cancel the contract by the customer? Because the customer may say, you had already committed to this, so as a penalty, you need to pay me a certain amount of money. So if we have determined that the loss we are going to make if we continue is 10,000, but if we were to cancel, the customer is going to charge us 5,000. We would then see that it's actually better for us to cancel than to continue, because we'll actually spend less than what we would have spent if we had continued. That's what we do when it is an onerous contract. So if it is an onerous contract, we make a provision of the lower of the 2 figures. The whole loss should be recognized immediately. Simply means we are going to debit profit and loss with the loss and then credit a provision. We are setting it aside. So if we then decide to continue, the money is going to then be coming from the provision, but we've already considered it a loss in the profit and loss in the year that we have calculated this. Then if the expected outcome or progress is unknown, which is often due to, let's say, it being in the very early stages of the contract, the revenue should be recognized only to the level of recoverable costs incurred. So this results in no profit being recorded on a contract with unknown outcomes. If you are not sure we would rather just say how much have we spent? We have spent 10,000. So we are then just going to recognize revenue of 10,000. So basically what we are saying is we are going to recover this 10,000 that we have spent from the customer. So for prudence purposes, let's just recognize revenue of 10,000, which is the amount we are guaranteed that the customer is going to pay us. Right. So from an examination perspective, we do not then expect to get a question where the expected outcome is unknown, because we need to be able to calculate certain figures. So the instances we are likely going to meet, perhaps even in reality, is where the expected outcome is either a profit or it's a loss. Right. So step number 2. So there are 2 acceptable methods of measuring progress towards satisfying performance obligation. We've already talked about this. We can either use the input method or we can use the output method. Then step number 3 is then the determination of the revenue and cost of sales we need to recognize in current year profit and loss. So we have already said there are 2 possible outcomes. Well, there are 3, but the third one we've said is unlikely that we are going to then get a question or even a scenario in reality where we are not able to determine whether we are actually going to be getting a profit or a loss from a contract, because that then defeats the purpose of going ahead when you don't know what you are going to be earning from a particular project. So we could be estimating a profit or we could be estimating a loss. So if from step 1 we have determined that the project is going to overall result in us making a profit, it means the project is profitable. So in the current year, our revenue is then going to be the total price. What have we charged the customer in total times the percentage progress, whether we've used input or output, how much, okay, how far have we gone with the project? We've calculated the percentage in step number 2. So if we feel that we are 60% through, we then say total amount we've charged is, let's say, for example, the total amount we've charged is 100,000. Right, so we are then going to say our price is 100,000. We have determined that we are 60% through. So if we are 60% through, it then means revenue is 60,000. But remember, we are doing this every year. So if last year we were 40% through, let's say last year we were 40% through, it means last year we would have recognized the revenue of 40,000. If this year we are 60% through, it means within the 60%, there's 40% we have done up to the end of last year. If we had 60% this year, it means what we actually did this year is 20%. That's why we are saying we less revenue recognized in the previous year, because this 40,000 was already recognized as revenue in the previous year. So if our total revenue is 60, it means what actually pertains to this year is only 20,000, which is the difference between 40 we have already recognized and the 60,000 that is revenue we have incurred from the point of inception to date. So total price times progress less revenue we've already recognized in previous years. We do the same for cost of sales. What are the total costs? So the total costs are the costs we've already incurred and the costs we are estimating will incur until we finish the project. We multiply it by the same progress percentage we would have calculated in step number 2. We subtract any cost of sales we would have recognized in the previous years for us to determine profit specific to this year. So this is what we do when we have determined that the project is profitable. But if we've determined that the project is overall going to make a loss, we are then going to say revenue is the total price times progress. So if it is this scenario, we are then going to say total price 100,000, progress 60%. We less revenue that we have recognized in previous years, which is 40,000, which means our total revenue here is going to be 20,000. Right. Now, we are not then going to determine the cost of sales here because we have already determined that this project is going to result in a loss. What we are going to rather then say is that what is the total loss on the contract, the overall loss we have determined from the contract. So if the loss we have determined for the contract is 10,000, we have said we know that when we actually then finish this project, if we consider the price we charged of 100,000 and the costs we are planning to incur, those we have already incurred and those that we are planning to incur to finish the contract, we have realized that it's going to result in a loss of 10,000. So the 10,000 is a loss, which means it's negative. We now then want to determine what is the cost of sales. That then results in us making a loss of 10,000 after recognizing revenue of 20,000, which means our cost of sales then becomes a balancing figure. So it means we are going to say 20,000 less 10,000 negative, which is going to give us 30,000, which means what we are actually anticipating is revenue is going to be 20,000, but cost of sales is actually going to be 30,000, which then results in total loss of the contract of 10,000. We then recognize this in profit and loss as an expense, which means we are going to debit profit and loss with 30,000. And then we are going to credit provision for an onerous contract of 30,000. So this then becomes a current liability. This then becomes an expense. So that's what we do when we have determined that the project is going to be making a loss. So this is step number 3. Now we want to then move on to step number 4. So step number 4 is the statement of financial position. So there are some contracts where performance obligations are satisfied over time, will be large scale projects and can span a number of years. So billing is then difficult and may not be accurate. So we are partaking a huge project, perhaps going to take a long time for us to be able to estimate the cost might actually be difficult. So we need to determine whether we are in the positive or in the negative with regards to what would have billed the customers and what would have received from the customer. So we are then going to estimate the cost to date. How much have we actually incurred to date? Let's say for argument's sake, we have incurred $30,000 to date. Then we are going to say, what is the profit that we have calculated we are going to earn to date? Remember our step number 1. Maybe we have estimated that the profit is 10,000. So it then means if we had incurred cost of 30,000 and we have estimated that the profit we are going to make from this contract is 10,000, it means the customer should then firstly pay us back all the costs we've incurred, which means they should give us 30,000. They should also pay us the profit, which is 10,000, which is the total that the customer should pay us is actually 40,000. Now, how much have we actually received from the customer? So the customer pays us after we have given the customer an invoice. So perhaps what we have billed the customer to date is actually 20,000. So we are saying we are entitled to 40,000 from the customer, but the customer to date has paid us 20,000, which means the customer owes us 20,000, which means it's a contract asset of 20,000. If we look at a different scenario, perhaps what we are entitled to get is 30,000 plus 10,000, which is 40,000. But let's say the customer has actually paid us 50,000 to date. It means the customer has paid us more than the profit component plus the cost we have already incurred. So the customer has paid us 10,000 more. So if the customer has paid us 10,000 more, it means it's a current liability because we actually owe the customer 10,000 for work we have not yet done. So that's step number 4. Now, so we want to look at a question and see if we are able to apply. So this question, we are going to be using the input method. We are going to do another question where we are going to be using the output method. All right, so Softmore House Limited specializes in the construction of train bars and gastropubs for their customers. The projects generally take a number of months to complete. The company has 3 contracts in progress in the year ended April 2021. Softflow have an enforceable right for payment for work completed to date. So if we are told that we receive payments for work completed to date, it means we are using things that we would already have done. So that's work that we have already done. So we are told that the cost that we have incurred to date for contract A is 200, contract B 90, contract C 560. We are estimating that we are going to incur additional cost of 200 for A, 110 for B, 140 for C. Then contract price, what we have agreed with the customer is 600 for A, 300 for B, and 750 for C. Then progress billings, the invoices we have actually given to the customer to pay, which we then expect that they would actually have paid, is 40 for A, 70 for B, and then 630 for C. So we said the first step is for us to determine whether we are actually going to be making an overall profit or an overall loss from this contract. So we are going to say contract A, contract B, and contract C. So our first calculation is, are we going to make an overall profit or a loss? So we're going to say, what is the revenue we are going to be getting from this, which is basically the contract price. So we're going to get 600 there, we are going to get 300 there, and we are going to get 750 there. So that's the contract price. Now, how much have we incurred to date? So the cost incurred to date, we are told that we have already incurred 200 for contract A. We have incurred 110 for contract B. And we have incurred 140 for contract C. Now, how much are we estimating that we are going to still incur until we finish this project? So the estimated cost to complete, we are going to incur a further 200 to complete A. Sorry, on this one, this is 90. So this is 90. We are anticipating that we are going to incur a further 110 there. And also this is not 140. This is actually 560. And we are anticipating that we are going to require a further 140 in terms of cost for us to finish this project. So as far as project A is concerned, we're expecting 600 after spending 200 plus 200. So we're expecting 600 after spending 400, which means we are expecting that the profit we are going to be making from this project is 200. Then we have spent 300, we're expecting to incur 110 plus 90, which gives us 200. So we're actually going to be getting a profit of 100 from this. Then from project C, 750 minus 560 minus 140, we are anticipating that we are going to be making a profit of 50 from this. So it means the gross profit we are going to be making overall after completing this project is 200 for A, 100 for B, and 50 for C. So remember our step number 3, we said this is step number 1. Step number 2, we said we are going to calculate the percentages of completion, either based on the input or the output. Then third one, we said we consider whether we've made a profit or a loss. And then we outlined the treatment if we have anticipated an overall profit, and the treatment when we've identified overall loss. So from this example, there's no loss. All of them are making profits, which is okay for us. So it means we then move on to step number 2. So step number 2 is the percentage of completion. So with regards to project A, our percentage of completion, now we are saying work completed to date. We have right of payment based on work completed to date. So we are saying what we have done so far is resulted in us spending 200. But our expectation is for us to complete this project, we would have incurred a total of 200. We have already incurred plus 200. We are hoping, or we have estimated that we are going to complete, which means our percentage of completion then becomes the 200 we have already incurred over the total cost of the project, which is 400, which means we are 50% through. So we are going to then say 50% there. With regards to B, so far we have incurred 90. The total cost to complete is 200, which means we are 45% through. Then with regards to C, we have already incurred 560. The total cost to complete is 560 plus 140, which is 700, which means we are 80% through. So we've determined these percentages of completion: 50 for project A, 45 for project B, and 80% for project C. So what we need to then determine now is the figures we are going to recognize in the statement of profit and loss. So in our statement of profit and loss, we are going to say A, B, and C. So we are going to say our revenue. So the revenue is, we are expecting a total revenue of 600. So far, we are 50% through, which means the revenue we recognize now is 50% of the total revenue, which means 50% of 600, which gives us 300. So 300 for now. So let me write it properly, 300. Then for B, we are 45% through. We then calculate 45% of 300. So 45% of 300 is 135. Then for C, we are 80% through. Calculate 80% of 750. We get 600. Now, from this question, what we are assuming, because we are not given the revenue that was recognized in the previous year. So our assumption is this is actually the first year. If we had been told that in the previous year, revenue had been recognized for contract A as 100, we're then going to say 300 minus 100 we've already recognized, and then we'll put 200 there. So that's what we will do if we had recognized other revenue in the previous years. Then after this, we are going to determine the cost of sales as well, using the same percentages. So we'll then say the total cost we are estimating we incur for A is 200 plus 200, which is 400. 45% of it should be recognized as cost of sales in the current period, which means we are saying, sorry, 50% for A, which means we are going to say 50% of 400, which will give us 200. So 200 is the cost of sales for project A. For project B, we simply say 110 plus 90, that gives us 200. 45% of 200, that is 90. All right. Then 560 plus 140, then the total of that multiplied by 80% will get 560. So again, you are seeing from this example that these amounts are exactly the same as the amounts that we are told as cost incurred to date, because this contract started this year. If this contract had started in the previous years, we'll then say these figures less any cost of sales that would have already been recognized in previous periods. So we then determine our gross profit. So our gross profit then becomes 300 minus 200 there, which is 100. So this is what then goes to our statement of profit and loss, 45 there and 40 there. All right, so this is number 3. Then for number 4, let me just do this to separate. So for number 4, we are now going to statement of financial position. So in our balance sheet, so we're going to say A, B, and then C. So in our balance sheet, this is what we are going to do. how much have we incurred to date? So what is the cost incurred to date? We are told that we have incurred 200 there, we have incurred 90 there, and we have incurred 560. So what it means is we are entitled to receive these amounts because we have incurred them on behalf of the customer, so they must refund us the expenses we have incurred. Over and above the expenses we have incurred, they must also pay us our profit. So how much profit have we recognized? So we've already calculated the profit. We have said in the current year, we are entitled, or we've earned a profit of 100 for A, 45 for B, and 40 for C. These are the amounts we've calculated here. So we are entitled to go and claim 200 plus 100 from customer for contract A, 90 plus 45 from the customer for contract B, 560 plus 40 from the customer for contract C. Now, we need to then determine how much have we received so far, because what we have received is going to be covering what we are entitled to. We are told that progress billings are these amounts. We have already billed the customer for 40, so these are progress billings. We have already billed the customer for 40 for contract A, which means we've already received 40 for contract A. We've already received 70 for contract B. We've already received 630 for contract C. So if we were entitled to 200 plus 100, which is 300, and we've already received 40, it means the customer now owes us 260, which makes it a current asset. So we're then going to recognize a contract asset of 260, or a contract receivable of 260. For B, we're entitled to 90 for the cost we've incurred plus 45, which is the profit we've made. We have received 70 so far, which means we are owed 65, which is also contract asset. For C, we were entitled to 560 plus 40, which is 600. We've actually received 630, which means we've actually overbilled the customer, which means we are actually the ones who owe the customer 30. So this then becomes your current liability. So these are the amounts that you then put in your statement of financial position. So first step, are we expecting an overall profit or an overall loss? Second step, how far have we gone in the completion of the project? So we calculate percentage of completion. In step number 3, which amounts do we recognize in the statement of profit and loss? We use the percentage of completion. If we are 30% through, then recognize 30% of the revenue, recognize 30% of the cost of sales. Then based on the cost we have already indicated and the profit we have estimated in step number 1, how much do we expect the customer to have paid us? How much have they paid us so far? So how much do they owe us, or how much do we owe them? So those are basically the 4 steps that we follow. So we have used the percentage of completion from a cost perspective because the contract says soft floor have an enforceable right to payments for work completed to date, what we have actually completed to date. So that's basically the first method, right? Let's look at the last example. So this example says Hard Floor House Limited constructs and refurbishes nightclubs on behalf of their customers. The project generally takes a number of months to complete. The company has 3 contracts in progress at the year end, April 2021. So we are told the costs that we've incurred, what we are estimating to incur, the contract price, work that has been certified to date, and the progress billings, the invoices we've already sent to the customers. Hard Floor House Limited calculates the percentage of completion by using the work certified basis. Okay, so calculate the effects of the above contract upon the financial statements. So the stages are the same. So step number 1, overall profit or loss. Right, so we are going to say contract A, contract B, contract C. Right, we do the same. What is the revenue or rather, let's say contract price, so that we don't confuse the two with stage number 3. So our contract price is how much? So we are told that contract price here is 416,684 and 400. Right. So this is the contract price. Right. What are the costs incurred to date? So we have incurred 320. We have incurred 540. And we have incurred 260. Okay, let me write legibly there. All right, so we are saying 320, and then we are saying 540, and then we are saying 260. Okay, then how much are we estimating? So cost to complete. We are estimating that we are going to incur further costs of 40 there until we complete this project, 90 there, and 120 there. Okay, so how much profit are we expecting? So we're saying 460 minus 320 minus 40. We are expecting to make profits of 56 there, 54 there, and 20 there. Then, so that's your step number 1. Your step number 2, we are then determining the percentage of completion, and we are told that we use work certified. So in our question, we are told that the work certified to date for A is 312. So what we are basically saying is 312 is work that has been certified out of a total contract price of 416. So we're basically saying 312 over 416, we get 75%. Right, then contract B, we are saying work certified to date is 456. So we are saying 456, we divide the 456 by 684, is the total contract price, and we get 66.67%. Then for contract C, work certified to date is 200, right, out of a total contract price of 400, which means we are getting 50%. That's step number 2. Step number 3, we go to our statement of profit and loss. So our statement of profit and loss, we are then going to say contract A, B, and C. We determine our revenue. So we are saying 75% through to complete a contract with 416. So I then basically saying 75% of 416. We get 312. For contract B, 66.67% of 684, we get 456. Then 50% of 400, we get 200. Then our cost of sales, same concept, 75% of the total cost we are going to be incurring, which means 75% of 320 plus 40. So 75% of 360, we get 270. Yeah. And then 66.67% of the total of 540 plus 90, we get 420 there. And then we get 190 there. So our gross profit then becomes 42 there, 36 there, and 10 there. So that's your step number 3. Our step number 4 is the statement of financial position. So A, B, C. So we are going to say how much have we incurred to date. So the costs we have incurred to date, we have already written them there. So we have 320 there. we have 540 there, and we have 260 there. We have the right to claim these amounts. These are the costs we have incurred on behalf of the customer. And then profit that we have recognized in our profit and loss. We have recognized a profit of 42 there, 36 there, and 10 there. Right. So from here, we need to then determine how much we have already received. Of this money we are entitled, how much have we already received, which are our progress billings. We have received 250 there. We have received 350 there. And we have received 230 there. So these amounts we have already received. So we are now saying, how much are we owed, or how much do we owe? If we're entitled to 320 plus 242 and we have already received 250, it means here we are owed 122. So this is a contract asset. We are owed 226, which is also a contract asset. We are owed 40, which is a contract asset. So that's basically how we recognize revenue. So there are certain instances or certain questions where the costs incurred to date are not given as a single figure. Like in this case, the costs incurred to date are given as single figures. In some questions, you may actually be given a number of expenses. So for example, we have incurred wages and salaries of so much, we've incurred electricity bills of so much, we've incurred raw materials of so much. You simply add them, you get the total, that's your cost incurred to date. Then you might be told that we are maybe doing all these 3 contracts, but admin expenses in total are 30,000. So you are given admin expenses, but the admin expenses pertain to contract A, contract B, and contract C. So what you then need to do when you're calculating the cost incurred to date is to determine the split. So the person will always tell you maybe 30% of the total admin expenses related to project A, 30% to project B, and 40% to project C, which means over and above what is directly related to project A, you are going to take 30% of 30,000 and add it there. And they take 30% add to B, 40% you add to C. So you, in determining the cost incurred to date, simply use the information given, add those that are directly allocated to each project, and then apportion those that are given as one figure. In every question will then be given how you allocate those or how you apportion those between the projects that we are running. All right, so that's basically as far as IFRS 15 revenue from contracts with customers is concerned. So I hope this was helpful. So this is the end of this discussion. Thank you.